Hi guys, Assalamualaikum and greetings. So in this particular video, I'm going to explain to you on our final chapter for this semester, which is Module 11 of your ENT300 on financial plan. So these are the learning outcomes. So by the end of this particular session, you should be able to understand the importance of preparing the financial plan, okay, and understand the process of developing a financial plan, identify the components of a financial plan. So number 3 is really important for you to do your assignment of business plan, yeah. From here, you'll be able to know what are the content of your financial plan. Okay. Number 4, analyze the financial position of the proposed business, and lastly, prepare the financial plan for your small business, which basically here preparing a financial plan for your assignment. Now, as for the introduction, you need to know that the financial plan actually incorporates all the financial data derived from the operating budgets. Remember, I told you that every managers in the marketing manager, operation manager, as well as the admin manager, you need to produce your budgets, correct? So from that particular budget, this is what the finance manager will do, okay, which you will be compiling all of these 3 budgets from the 3 different plans, okay, to come out with your financial budget. Okay, so based on the financial data, projections are prepared via the following pro forma statements, which are cash flow, income or profit and loss statement, as well as the balance sheet. So first thing you need to know why it's important for you to prepare a financial plan. Okay, so it is actually crucial to the overall business plan that is developed for a particular business or project, because it can summarize and also determine the size of investment. That means for you to actually start a business, how much will be a cost that will incur for that particular business that you would like to set up. Okay, and you also need to you'll be able to, when you do the financial plan, okay, you will be able to identify and propose the relevant sources of finance. That means you need to know where can you get the money, or where can you get money into the business. Okay, number 3, to ensure that the initial capital is sufficient. Okay, to analyze the viability of the project before actual investment is actually committed, and also to use it as a guideline for the project implementation. All right. So the process of developing a financial plan, okay, is when you have to make use of these particular 7 steps. Okay, the first one, you gather all the financial input. Okay, second, determine the project implementation cost. The third one, determine the sources of finance. Fourth step is to prepare pro forma cash flow statement. Step number 5, prepare the pro forma income statement. Number 6, to prepare the pro forma balance sheets. And also number 7, the last step is to perform basic financial analysis. Now let's look at each one of these steps, okay? Now in step 1, okay, the process of developing a financial plan for a specific project begins with the accumulation of the financial information from the 3 operating plans, which are the marketing plan, operation plan, and also your organizational or administrative plan. Okay, so the financial requirements for each plan are presented in the form of budgets known as operating budget. Okay, the name is operating budget, yeah, not necessarily it's just operation budget. All right, so it's just operating, for you to operate the business, for you to run the business, okay, for the business to actually to business to do the work, or to for you to produce, or for you to deliver the services. Okay, so these are the 3 budgets. So in addition, okay, the monthly or annual sales forecast should be, which you derive it from earlier in the marketing plan, is very important input for the financial plan. Okay, and after gathering all the information, the financial plan is prepared in terms of what we call the financial budget. Okay, now like I told you, you will need the marketing plan budget, okay, the marketing budget, and the sales forecast. Okay, remember I already asked you to find out what would be your annual sales forecast. Okay, so this is when it is important. Other than annual sales forecast, you also need to find out your monthly sales forecast. Okay, then you can actually do your financial plan. Other than that, for organizational plan, you will need the budget from the administrative side as well as the operation plan that will actually provide the operations budget. Okay, from these three budgets, okay, then you will be able to do your financial plan, which includes project implementation costs, sources of financings, the cash flow statement, income statement, performer balance sheets, as well as performing the financial analysis. Second step, you will determine the project implementation cost. So the project implementation cost incorporates both the long-term and also short-term expenditure needed to start a project. For the long-term expenditure, okay, it refers to expenditure such as the procurement of plant. If you buy any plant here bukan pokok bunga tu, plant here is a factory. Okay, let's say you buy a factory or you buy a shop lot, okay, buy machineries, your equipment, vehicles, and other fixed assets needed by the new business. So those will be included as long-term expenditure. Basically, long-term expenditure are items that you get from your fixed assets from each of the three budgets: marketing budget, operation budget, and also your admin budget. Okay, which you have the fixed asset column. So this is what we call the long-term expenditure. While the short-term expenditure will include payments of utilities, salaries and wages, factory overheads, purchase of raw materials, and all other expenses in your working capital or your monthly expenses. Okay, so from there you will be able to know there is a capital expenditure, your fixed asset, working capital, your monthly expenditure, monthly expenses, other expenditures, and also some contingency costs. This is how your project implementation cost schedule will look like. You will have your capital expenditure, the fixed assets that you purchase. Working capital, you may want to consider about 2 months working capital, yeah, because when you first initially started a business, you might have in mind that perhaps for the first month, you may not get the income that you required. Okay, so that's why it is safe for you to put working capital. At first, you put 2 months. Okay, and then other expenditures, and you may want to add some contingency costs according to some percentage. The ideal percentage will be 10%, but you can also put 5%, 3%, but not more than 20% of the contingency lah. All right, so because typically the contingency cost will be 10% from the total cost that you have here. From A, B, and C, we have this amount, 125,000. So contingency is 10% from 125,000, then the total project implementation cost will be 137,500. Now bear in mind, you do not have to list down this all one by one and calculate this one by one. Later on in another video, I will teach you on how to use the financial planner template, okay, which you will require to key in all of the information in an Excel, Microsoft Excel, yeah, template. So in that template, it will actually auto compute for you all of these figures. Okay, what you need is just to key in some figures, then it will compute to you what will be your total project implementation cost. Step number 3 is to determine the sources of finance. Sources of finance referring to the sources where your funds, okay, or where the money that can finance a particular project implementation cost. Okay, so this can be categorized into internal and external sources. Internal sources mainly come from the equity contribution from entrepreneurs or the partners. So let's say you have a capital. You know, capital is like modal. You know, in Bahasa Malaysia, modal is capital. In English, capital lah. Okay, modal. You need the capital. So let's say as a student, because you have to keep some of your PTPTN money from the allowance that you get from some part-time job that you did, so you do have some saving in your account. Let's say you have around 5,000 ringgit. With that 5,000 ringgit, you would like to put that as a capital contribution to your partnership. Remember, you do this particular business plan in a partnership. Okay, so the whole members, all of you contributed, let's say 3,000 or 5,000 to the business. So that whole amount will be considered as your internal sources, okay, which is the equity contribution. Equity is actually asset contribution lah, or some of the money that is contributed by the entrepreneurs or the partners to the business. Okay, it can be a contribution in terms of a cash or other assets. For example, if you are saying that you will not need to buy any other new computers for you to use in the business because you are contributing your own computer or your own laptop as one of the assets to the business. Okay, or let's say your father give you a motorcycle and you were thinking that okay, that motorcycle will be used for the business for you to deliver some of the products. So that will be in terms of other assets, right? While the external sources of finance are mainly derived from the commercial banks, the finance company, and also the government agencies, it may come in form of term loans, hire purchase, or even the grants. Okay, so these external sources typically are from commercial bank. All right, so that is when you will be able later on to tell that you will not be getting any grants from the government lah. Okay, what you will get is actually some money from the commercial bank. So the total amount of fund that has to be sourced should equal to the total project implementation cost. This is to ensure that project is fully funded and to avoid the risk of under-financing. Okay, so as you already computed your total project implementation cost, that total project implementation cost should equal to the sources of finance for your business. So here are the components of sources of finance. Yeah, you have internal sources, equity contribution, which from your partners, while external sources are from either term loan, from hire purchase, or others. Okay, hire purchase, if let's say you buy vehicles, okay, normally vehicles, or you buy building plants, okay, plants is the factory lah, shop lot. If you buy it, not renting, yeah, we're not talking about renting here. If you buy, that means you are trying to get the bank to pay on behalf of you to the manufacturer of the car or the developer of that particular shop lot. Okay, term loan is from the banks lah, right? The typical loan that you will have to apply for, and also you will get the amount of money from that particular bank that is considered as the term loan. So this is how it will look like. Your equity contribution in terms of cash or even assets, okay? Your external resources from hire purchase and also let's say from term loan. If you don't have hire purchase, you will just put 0, okay? And other sources. So you will have 137,500. Do you remember this is the same amount as your total project implementation cost? Step number 4. This is when you prepare the pro forma cash flow statement. What is cash flow statement? It refers to the projected statement of cash inflow and outflow throughout the planned period. Okay, under normal circumstances, your cash flow statement is prepared for a consecutive 3 years. Okay, which detailed by month for the first year, and second year and third year is just by yearly total lah. Okay, however, longer period are sometimes needed depending upon the project undertaken. So for your business plan assignment, you are required only to prepare for the first 3 years. Okay, so for your cash flow statement, okay, it must show the following information: the cash inflow, cash outflow, cash deficit or surplus, and also the cash position. Okay, so cash inflows will show all the projected amount of cash flowing into the business. This is the amount of money that will come into your business. While cash outflow, the word outflow, that means this will be the projected amount of cash flowing out of the business. That means your expenses. What are the things that you will spend on? Okay, duit keluar lah. For cash inflow, that means duit masuk. Okay, and then you have the cash deficit or surplus. This is where you will see the difference between cash inflow and outflow. If inflow is more than cash outflow, that means you will have cash surplus. Lagi banyak duit lah, because cash inflow is much more. You have more money than money that is going out. Okay, however, if you have more cash outflow, okay, that means cash inflow is little or less than cash outflow, you will have cash deficit. Okay, and cash position is actually the beginning and ending cash balances for a particular period. Let me show you. Later on, the example, yeah. But before that, these are the elements of cash inflow like equity contribution, the term loan, cash sales, collection of receivables, and also some other money that you will be earning. While outflows, okay, cash outflows includes of all of the expenses that you need to pay. Okay, so this is the example, all right. You can see here that these are the cash inflow, money come in, because this perhaps this 27,500 are the amount that each and every member, the collective amount of each and member's contribution, okay, partner's contribution. While you get the term loan from the bank, perhaps 45,000, and monthly cash or sales forecast, okay, monthly sales forecast is 20,000 every month. Okay, then this is derived from your marketing budget or marketing plan. Marketing plan has planned how much sales that you will earn for the first year, sales forecast. Okay, and then the cash outflow. Okay, cash outflow, all of the expenses that you will need to pay throughout the whole first year and also first month until the 12 months. Okay, then you add up all these C items, you get the total cash outflow. Next, you minus the inflow and outflow, then you'll be able to see whether you get cash surplus or cash deficit. You don't have to compute that because in the Excel template that I will teach you later on, it will be auto computed for you. What you need to do is to understand what does it means. Okay, like I told you, beginning cash and also ending cash balance. Okay, this will be also auto computed for you. Then for the first year, it will show like this, and also monthly just now. Alright, then the second year, it will automatically computed like this, second year and also third year. Okay, so don't worry about this thing. Next, step number 5, prepare the pro forma income statement. Okay, so income statement shows the expected profit or loss for the planned period, usually for the 3 consecutive years. Okay, so these are the elements. You need the sales, gross income, and also net income before tax. It derived from here, sales minus cost of sales, you get the gross profit, and gross profit is actually the operating expenses which equal to your income before tax. Okay, again, do not worry about this because you will not need to compute this manually. As I told you, with the template that I'll give you later on, you'll be able to get all of those are auto computed. Okay, you will be able to get something like this. What you need to know is that how much that you will be earning here, the net profit before tax. Okay, this amount for the first year, second year, and third year. This is actually the profit that you are going to earn for the first year, second year, and also the third year. Number 6 is to prepare pro forma balance sheet. All right. So the pro forma balance sheet actually shows the financial position of the business at a specific point in time in terms of assets owned and also how those assets are financed. Okay, which again it will be prepared for a 3-year period, and the components of balance sheet consist of assets, owner's equity, and also the liabilities. Okay. So assets, these are your, from the assets lah, there are non-current asset and also current asset. Non-current assets are actually fixed asset lah. Okay, like you already know what are your fixed asset. While the current asset are basically your sales. Okay, short-term assets that can be converted into cash within a year. Okay, and then owner's equity will be your capital contribution. Right. Next is liabilities. Liabilities are the amount of owed by the company or the business to the outsider. What you owe, not own, ya, owe. That means you are owing someone. You hutang. Okay, liabilities are your hutang. Okay, and then there are also what they call non-current or long-term liabilities and also short-term liabilities. Okay, you just go and read this through from your slides. Okay, this one as well. Alright, so this is how your pro forma balance sheets will look like. Now bear in mind that for a pro forma balance sheets to be balanced, that's why it is called balance sheets, okay? It must show that total assets equal to total owners' equity and liabilities. As you can see here, let me show you here highlighted in white. Oh, no, not white. Green, yellow. Okay. Total assets here, okay, 139,900 for the first year must equal to the total owners equity and liability for the first year. Same goes to the second year, total asset equal to 166,300. Your total owners equity and liabilities for the second year also must equal to 166,300. Same goes to the third one here, 223,975. Third year also here, 223,975. Okay. Next one, the basic financial analysis. This is the final step. Okay, final step, which will tell the performance of the business. Okay, which involve two steps: generating information from the financial statement and also interpreting the result. You don't have to worry about the generating information from the financial statement, because as you key in all the information in that particular Excel template, okay, all of these financial analysis are being computed automatically. Okay, what you need to know is actually interpreting the results. Okay, so you'll be able to see later on the financial ratios. Okay, and these few slides later on, you will be able to see that information. Yeah, basically these are example. Okay, all the examples, your income statement, and also the balance sheets. Okay, from here, then you'll be able to calculate, right, the liquidity ratios, the current ratios. Don't worry about the formula and all those things. Yeah, again, like I told you, it will be generated, auto computed by the template. Okay. Next, you also may need to look at the quick ratio. What is it? Okay, what is how you want to derive, or where do you get the amount to perform your basic financial analysis on quick ratio? Okay, efficiency ratios, the inventory turnover. This one, okay. All right. Next one. I'm not going to go through all of this here, because all of this will actually auto computed, but what you need to know is actually what it means. Okay, like for example here, return on equity shows what the business has earned on its owner's investment in the business in terms of the percentage. Okay, for the first year, the return of equity will be 18.53%, second year 31%, third year 42%. Okay, so the higher the percentage is, the better, right? This is solvency ratios. Okay, and then next, you will have here time interest earn ratio. We're talking about how much interest that you'll be earning. Okay, and lastly, okay, when you talk about financial plan, is important part of the business plan, which incorporates all the data from your three budgets. Okay, marketing, operation, and also administrative budget. Okay, from the financial data, you'll be able to get a clear picture of the amount of money needed in order for you to start the business. Okay, especially on your sources of finance, amount of cash available, and also the financial performance and position of the business. And of course, there are three outputs, okay, that you need to what I call it, to look into when you prepare the financial plan, including the cash flow statements, okay, income statements, and also the balance sheets. Okay, and the business financial data gathered in the financial statements are analyzed so that you'll be able to have the overall financial picture of the business. That's when you do the financial ratio. All right. So that's the end of module 11. This is the end of our chapter for the whole semester for ENT300. And I hope after this, you'll be able to understand on when I explain to you on how to key in and also how to do the financial template, okay, for your business plan. Thank you. And before that, if you have any questions, of course, do ask me in our chat group. Right? Thank you guys.